Welcome back to Turning Hard Times Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Axel Merk with us once again. He is the President and Chief Investment Officer of Merk Investments, manager of Merk Funds, founder of the firm bearing his name, and he is really an expert on macro trends as well as an innovator in gold and currency investing. And we've certainly had Axel on this show in the past. He's well known, frequently seen on Bloomberg and CNBC and all the main channels, the business channels. So it's really good to have you back again. Thanks for joining me, Axel.
Good to be with you.
We talked last week about some of your products, and you have a lot of other things that you're involved with that besides the bullion account, the bullion product, but you also, ASA, Gold and Precious Metals Fund, it's been around for a long time, I believe. It is a closed-end fund that invests in gold and silver mining companies, I guess, primarily, right?
Yes, founded in 1958, yeah.
And I had in mind that it must have at one time owned a lot of the South African gold stocks.
That's right. That was kind of how it got started in the beginning. You couldn't invest in many of these things in the U.S., and so that's where it had an origin. Indeed, it was a South African company. It was incorporated in South Africa, and it is one of the few foreign entities to date that trades as a closed-end fund in the U.S., and it was reincorporated in Bermuda beginning of the last decade. And so it's a bit of an odd beast from that point of view, but we were awarded the management of that fund about a year ago in April last year, and we reshuffled the portfolio, changed quite a few things. I'm not around since 1958, just to make that clear, right?
Well, I know.
And there were some issues, notably on the cost side, and we gave this portfolio new life, so to speak, and it's a very different portfolio from how it was a year ago.
So I've noticed that it tends to sell under its net asset value, and fairly significantly so. Why is that the case?
Well, first of all, closed-end funds are not like ETFs that have a market. It does have a market maker, but since there is no creation and redemption, the last time the fund issued shares was in 1958. There is no arbitrage opportunity, so to speak, and so many of these funds trade at a discount. ASA has traded a bigger discount than some. And one of the things that we have seen is when we outperform, the discount tends to get bigger. And we've tried to address that. Well, and similarly, in March, we were hit, as anybody else, by the downdraft, especially since we've shifted the portfolio to be more assertive, we call it, more downstream. We've been helping to finance many of the small mining companies. And so we got whacked pretty badly, so to speak. And so we're at the bottom. The discount was low. Now that we're recovering and hopefully outperforming again, the discount has gotten a little bit wider. And we tried to address it through a bunch of things, including more communication. Also, we even have a Google ad campaign running to get new faces. Like the gold investor is an old investor, and I mentioned this once to Frank Holmes, who I'm sure has been a guest on your show.
Sure, yes.
And he says, well, the gold investor has always been old and will always be old. So let's say we want to get a new old investor, then, so to speak, new faces to look at that. And then particularly as a closed-end fund, we think by helping to finance many of these projects, we think that this very odd and archaic structure, so to speak, that's not so common anymore these days, has a purpose.
Mm-hmm. Well, so you actually, I'm looking at your portfolio, and I noticed quite a few names, some of which I cover in my own newsletter. So you definitely are down market, and so does the fund take private placements or get involved in buying off the market, or how does it do it? It gets into companies that are developing projects that in your view, have great upside potential, or what? What's the philosophy?
So the mandate is to invest in precious metals companies, obviously, and we have reasonable flexibility on how to do that. And as I indicated, we've gone downstream, away from the royalties, away from the big names, more to the smaller ones, development companies, some exploration plays. Most of these are public, and what happens a lot with these small gold miners, because they're in notorious need of capital all the time, they buy a shell company, and so they have a Canadian listing, and so when you participate in one of these capital raises, tend to be publicly traded. They sometimes issue warrants as well. There is a market, but not a very liquid market for some of these warrants, and so we don't do entirely private placements. We don't go that far downstream.
Mm-hmm. Well, it's certainly interesting, but it seems strange. Why would the difference between the NAV and the price get larger when you're outperformed?
Well, because the message has to sink through, right? I mean, for years this fund has been rather dull, to phrase it politely, and so the message has to get through about what this portfolio is all about. That it is more dynamic, and that it is, and also as you're aware, in the initial boost we've had in this segment, the seniors kind of had the first leg up, right? As is very common when you have a new bull market. And so the message has to get through that this is trickling through down there to these others. And so we are very confident and comfortable with the positioning. But with a closed-end fund, like with any other product, it's about communication, and that's our job. So we've had some webinars, we do other things, and then we try to be very clear about what we do, and then over time that may attract the right sort of investor.
Well, certainly if you're a value investor, you look at something that's selling at, 12, 15, 20% below NAV, you would think that's something that would be attractive. So, I hear what you're saying. The big guys...
There's no guarantee that the discount is going to get smaller, but yes, you do get them at a discount.
Yeah. Well, anyway, it's a very interesting product that I hadn't really been aware that you were involved with, and as you say, you just really took over it fairly recently, within the last year or so, I guess, right?
That's right. In April last year, now it took us, we were involved for several months to help streamline many of the things. The fund used to be internally managed, and because of the bear market in gold, the cost structure was just got out of whack, and so we worked with the board to put various best practices in place. It's not that they did bad things, but to modernize many of the things. And with that, I think it's more of a traditional structure now. It's still a closed-end fund. It's still a Bermuda-based fund, and so from that point of view, it's a bit of an odd vehicle. And so anybody who looks at it, please do go to our website and look at the disclosures, because that does come with some quirks. But at the same time, hey, we do like it. So the short of it is, if you do buy it, you may want to hold in a retirement account, because otherwise you have some other tax issues that come with it. Some
other issues. Okay, good enough. Of course, everybody should talk to the tax accountant then, if that's the case. So, fair warnings there, I guess, and you're suggesting people go to the website. So is it ASA, if they just do a Google for ASA, or how do they find the website?
It's asalimited.com, asaltd.com, yes.
Okay, excellent. Well, I want to ask you, get some of your thoughts on the markets and the macroeconomic picture here. My goodness, it's certainly something different than we're used to, that's for sure. Recently on Bloomberg, I saw a clip. You talked about inflation being one of the most underpriced risks. And that was on February 12th, before the coronavirus really reared its ugly head in a major way anyway, and shut everything down in the economy. And so, at that time you noted that we were still having full employment. Well, I mean, employment has dropped off a cliff, as everybody's well aware of. Now that that's taken place, we just talked to our last guest, and she was suggesting that in the near term we could be looking at some real deflationary issues, though I think in the longer term she thinks inflation is a real risk. But what are your thoughts now? Because you made that statement, February 12th, and I know very well things were humming along pretty nicely and at that point in time, but now we're not at full employment. So what are your thoughts about the outlook for inflation or deflation as we go forward?
Sure. Maybe you mentioned a bunch of topics. First, for context, the reason I had mentioned it is because we were pulling people from the sidelines in the labor force while we were at record low unemployment, and I said at some point we're going to kind of exhaust that pool of available labor. Now, we don't have that problem right now, except that Powell says, hey, this worked so great last time around, I'm going to wait again before I tighten any policy, because you see we can go very low and this is not going to be an issue. And then, of course, we've had some changes. But to just look at the kind of assuming at some point we'll recover from this. The sort of policies that have been put in place or are contemplated to be put in place may well be much more inflationary than the past. So we didn't have inflation last time. Even Bernanke is hedging his bet about how we're going to come out of this one. And the reason is that when you give, say, a corporate tax cut as we had recently, well, that's inflationary in an indirect manner, right? It boosts the economy, boosts employment, and so forth. But when you do infrastructure spending or direct cash handouts to people who actually need the money, right? I mean, if the wealthy get wealthier, that doesn't mean they spend a lot more money. But if you give people who are desperate for cash more cash, they will spend it. And so the sort of stimulus we are seeing and will see is more inflationary. And then talk about disinflationary environment right now. Well, yes and no. I agree with that in principle, but I think we touched on it last week. When you have the CPI come out, now I know plenty of people have issues with the CPI in general, but for last month we know it was wrong. The CPI is supposed to measure the average consumption basket, and while nobody is average, we all know that nobody drove a car last month. And so the weighting of gasoline is completely out of whack. And then conversely, of course, what everybody did use is go to the grocery stores, and those prices went up. And so we had inflation last month, despite what the official numbers say. Overall, of course, yes, with all these efforts to keep everybody in business, which I guess there's a good reason to, we will overproduce many things, right? I mean, let's look at the automotive market. Anybody who lost a job is going to return the leased car. We're going to have an abundance of used cars. So why should that's going to put a lid on price pressures in cars? But inflation isn't something that comes uniformly. It pops up in different places, and suddenly it pops up in more and more places. And so I think that's where we see a real risk at the tail end of all of this.
Yeah, it would seem so. Helicopter money. I mean, it's the propensity to consume is at least one of the Keynesian ideas that makes a lot of sense to me. That when you put the money in the hands of people who are poor, and they need to put food on their table and they need to pay their rents, that they will do that. And if you give the money to a rich person, they'll probably put it in their bank account or buy a stock or whatever. And we've seen, I would argue, tremendous amounts of inflation, but in the financial assets. Since 2008, before that too. You would agree with that, I guess, right?
Oh yeah, sure.
Yeah, we just, if the rich get richer, the people that don't have to spend all their income on just simply living costs and can afford to buy some things. Hopefully, a lot of people in this listen to this show have enough to buy some gold and some assets and are doing okay. But that propensity to consume. So we're going to your friend out there. Nancy Pelosi, she's from your district, I believe, probably, or right around San Francisco there somewhere. Well, she's suggesting that everybody should have, $3,000 a month or $10,000, or everybody should get $100,000 a month checks, or what? I mean, so I would think at some point we'd start to see hyperinflation.
If you think about it, well, the money doesn't get you anywhere. That's the problem, right? If you spend, the last I heard was $2,000, maybe we're at $3,000 now, but at $2,000 a month or at all, if you spend, people need a job. They don't need a handout, right? And so if you spend $2,000 a person to have that person work safely, I think we could open up this economy in no time. Right, and by the way, they do that in much of the rest of the world, and they don't spend $2,000 a person, and so I'm not suggesting we shouldn't take precautions as we open up and whatnot, but paying people to stay at home is hugely expensive, and is causing a lot of damage because money doesn't quite grow on trees. Last time I checked, and so it's a waste of money. It just increases our debt. And sure, for the time being, the markets are benign about it. But fear not, our policymakers are able to mess this up in any which way, right? And so we'll just see what they cook up next.
We'll see how they mess things up next, is the way you can put that. Axel, you have quite a bit of experience in the currency markets, and what is your view of the dollar now?
Well, the dollar had been a beneficiary for numerous reasons of late because of the panic trade. Because a lot of people borrow dollars abroad, they scrambled to reduce the leverage, and just like in the short squeeze, there was a flight into the dollar. If I look at the markets right now, the LIBOR market, the interbank borrowing market has all but normalized in the meantime, and so and as we speak today, the dollar is weakening. I think that's one part of the trend. The next part is that on an election is coming up. Right now, the odds are that whatever Constellation will have, as you've just pointed out, will be spending a boatload of money. So that may be inflationary. When combined with a Fed that's not going to take assertive actions against it, that may weaken the dollar. And then on a purchasing power basis, our analysis shows the dollar is about 20% overvalued. And so that's a downward trend. Now, that doesn't mean the dollar is going to go down every day. Indeed, just because it's expensive doesn't mean it can't get more expensive. But in my analysis, it favors a weaker dollar. And intriguingly and interestingly, obviously gold appreciated versus the dollar. But other than that, the dollar had appreciated versus just about all currencies in recent months.
What about the dollar's role as the world's reserve currency? I want to run an idea past you and see what your response is. This is from Alistair MacLeod, who is a frequent guest on this show. He argues that if the dollar rates go negative, and I don't know if you think that's a possibility. Do you believe that the U.S. That the Fed will push into negative territory with the treasuries?
If you asked me some of these questions years ago, I would have said never on earth, right? And now it's a little different. Now the little dip in the Fed funds futures market we saw recently, I think that's more a numbers game, because what happens usually with the market, let's say the Fed says, hey, rates are going to stay at 2%. And the market then believes they're not going to go higher, but they always have to price in the opportunity of a shock. And so the futures market tend to trade a little bit lower. And now the Fed funds futures are at 5 basis points, 0.05%. And so for a while, not today, but for a while, they priced in just slightly negative rates for next year. And then obviously Powell said it's not going to happen. And then right now it doesn't. So I don't think it makes any sense. I don't think the Fed is going there. But I'm never going to say never, because in this world, a lot of taboos have been broken.
Yeah, it's crazy. I mean, a lot of things. I mean, 2008 seemed extreme, but now maybe we're looking at something even more extreme for sure. But here's the idea that Alistair MacLeod has run by on this show, and it makes sense to me. He suggests that negative rates for the world's reserve currency is a bigger deal than, let's say, for the yen or the euro even. And that's because of a concept of time preference, which I think you probably agree with. The idea that whatever I own has some time preference to it. Having it today is worth more than waiting a year or two or sometime into the future. And so Alistair argues that if the U.S. dollar goes negative, if rates go negative, why would anybody want to own the dollar when you can go out and buy gold and maybe get 1 or 2% on it, or at least you don't lose value of it on it, holding it, or silver or copper or whatever else. So his suggestion is that if the U.S. dollar as the world's reserve currency goes negative, and since everything in the world, all these commodities are priced in dollars, who would hold the dollar any longer? I don't know what your thoughts are of that.
Well, first of all, with regard to gold doesn't have much of a correlation to most things. The one thing we do see a correlation with is real rates, notably on a 10-year basis. And indeed, Japan actually has the highest real rates right now in the major countries here. Just to show you how absurd this world is, right? And so the nominal rate obviously is a factor in that. Now, you could have made similar, I think there's a risk of that, but you could have made similar arguments about the euro and other currencies. And we invest around the globe in currencies. And by mandate, we kind of have to hold something, right? And if you're the Treasury Department of a large corporations, you've got to hold something. As an individual, you can stuff it under the mattress. But a big S&P 500 company or a big British company or wherever, they got to do something, and they're not in the gambling business, and so they will, up to a degree, hold it, even if it's negative yielding. The bigger issue I see in the U.S. is that you have a money market fund industry where people are used to stable net asset value, and that's very difficult to sustain when you have negative rates. And so it will break fundamental pillars of the U.S. financial system. Not that it means everything will break down, but there's a lot of damage that will be caused with negative rates in the U.S. You don't have those issues in the rest of the world as much because many of these markets are not as developed.
Yeah. Well, there's a lot to think about there. I guess just with 30 seconds left, so what should people be doing right now?
Well, they should follow their process. I mean, in this sort of environment, it is easy to the glasses are full one day and half empty the next day. Have a plan and stick to it. Only revise it if you think that you're really wrong, but not because you hear somebody else, including myself, say something else today or tomorrow.
Yeah. Well, there's one thing that we're pretty sure of is that over the long run, gold is money and it holds its value, and fiat currency, contrary to that, loses value. That's pretty predictable. Aren't both of those statements pretty predictable? Paper money will decline in purchasing power, and gold will not.
If you have expenses tomorrow, the price of gold is volatile, right? So if you have a major expense tomorrow, there's a good reason to hold cash. Now, I happen to like gold, but I mean, you've seen how much gold has moved of late, right? And in the short term, it can do anything. I like it in the long. Historically speaking, gold has always done well. You never quite know why you hold it for tomorrow. I happen to like it, yes.
Right. You hold it for tomorrow for insurance, for sure. All right. Well, thank you, Axel. Thank you so much for being with us.